Welcome to the Deep Dive. Today, we are undertaking a truly massive mission, cutting through the complexity of mutual funds.
Mhm.
This deep dive is built entirely on the stack of comprehensive sources you shared with us, and we are going beyond just the glossary definitions.
Yeah, we have to.
We're focusing intensely on the operational structures, the core mechanics of valuation, and the strategic differences between all the fund types.
That's necessary because understanding the structure, the how, and the why is the shortcut to becoming truly well-informed.
I see.
Our goal here is to demystify the internal workings so that the mutual fund stops being this kind of black box and starts being a clear, calculated investment vehicle for you.
Okay, let's unpack this by starting at the very, very beginning with the fundamental question. What is a mutual fund for?
Right.
Fundamentally, your sources define it as an investment product that allows you to gain crucial exposure to diverse asset classes. We're talking about everything from equity and debt all the way to...
Gold, real estate.
Exactly. Physical assets like gold or even certain real estate exposures, all without the requirement of you engaging directly in those complex markets yourself. It is, the ultimate pool of diversification.
And the structure that facilitates this pooling is key. To make it immediately relatable, your sources provided an excellent analogy, which we should absolutely use as our conceptual foundation for this discussion.
Well, the potluck dinner.
The potluck dinner.
I love this because it instantly humanizes what is otherwise a very sterile, very, financial structure.
Exactly. So in this analogy, you, the investor, are the guest bringing a dish. That's your small investment.
Okay.
The total collection of all those dishes is the fund's corpus. But, and this is the important part, 3 core entities are necessary to run this dinner successfully.
Okay. So first up, you have the people who actually set the party up
Right.
and pay for the venue, the sponsor.
That's right. The sponsor acts as the initial promoter, the entity that lays down the capital, and the foundational trust to set up the fund house. They get the entire operation running and hold the keys to the initial setup.
Second, and this role is perhaps the most crucial for the investor's safety, we have the trustees.
Mm-hmm.
In the potluck analogy, they are the crucial guests who make sure everyone plays by the rules and that the dinner is fair, ensuring, for example, that the chief chef doesn't just run off with all the profits.
Absolutely. Their primary function is strictly fiduciary. They are there to take care of the interests of the investors. That's you across all the various schemes launched by the fund house.
So they're like the watchdog.
They are the watchdog. They legally hold the assets on your behalf and ensure that the third critical pillar adheres strictly to the scheme's defined objectives.
And that third pillar, the person organizing the entire table, managing the recipes, and making sure every guest gets a proportional taste of every single dish. That's the asset management company, AMC.
Or the fund manager, yes. They are the operational heart.
Their responsibilities are vast and very detailed. They launch the specific investment schemes, handle the marketing, collect all the funds from the investors, and most importantly, they are responsible for deploying those funds in the market strictly according to the objectives outlined in the scheme's charter.
And we should remember, the AMC doesn't operate in a vacuum, right? It requires a massive regulated infrastructure to function at scale.
It does. I mean, we're talking about a critical support system. They need banks for transactions, registrars, and transfer agents to accurately manage the millions of unit holder data points.
Wow.
Investor service centers for support, brokers for facilitation, and perhaps most importantly, custodians.
What does the custodian do specifically?
The custodian is the entity that physically holds the underlying securities, the stocks, the bonds on behalf of the fund. They ensure that the assets are protected and accounted for in that regulated ecosystem.
That sets the stage perfectly for Section 1. Launching a fund and defining the mechanics. How does a fund even start, and how do we determine its value?
Right from the start, the process is highly regulated, which is all about ensuring transparency. Let's look at the very first step, the launch.
This begins with a new fund offer, or NFO. This is the initial subscription period, often lasting a limited number of days or weeks, where the fund is essentially raising its initial seed capital from investors.
It's your first chance to buy units.
Right. Often at a fixed, low initial price, like 10 rupees, before the fund even starts trading in the market.
And for this NFO to commence, 2 absolutely critical documents must be prepared and made available to you.
The first one, the detailed blueprint, is the Scheme Information Document, or SID.
Mm-hmm.
This is comprehensive. I mean, it details the precise investment objective, the mandated asset allocation patterns, the specific strategy the fund manager intends to use, like value investing or growth, and every single associated cost, including the expense ratio. It's the full contract.
And the second document is designed for accessibility. The Key Information Memorandum, the KIM.
The shorter version.
Exactly. This is the abbreviated version. It contains all the high-level critical details, the abridged offer document that must legally accompany the actual application form.
So it ensures that you, the investor, get the most important data points without having to wade through the massive complexity of the full SID just to make a quick purchase.
You got it.
Now, once the money is in, let's go back to our potluck analogy for a second. We said the investors own the collection of dishes.
Right.
Your source confirms this. The portfolio is owned only by the investors who contributed the funds, and that ownership is held in exact proportion to the capital they contributed.
This proportional ownership is governed by the investment objective. This objective is the fund manager's mandate. It's like the constitution of the scheme.
So it dictates everything.
Everything. It defines precisely what the scheme intends to achieve, maximizing capital appreciation, generating steady income, and by extension, it dictates which asset class it selects and what inherent risk-return profile the investor is signing up for. Everything the fund manager does flows from this one objective.
Okay, moving into the financial plumbing. When you invest money, your holding is immediately converted and represented in terms of units.
Yes.
It's these units, not just the rupee value, that define your slice of the total ownership pie.
And here's where the regulation ensures minute fairness. Units can be allotted in decimals.
That's interesting. So you don't have leftover cash.
Exactly. If you invest a sum that doesn't perfectly divide into a whole number of units at the current price, those fractional units are still allotted. This ensures that literally every single rupee of your investment receives value, preventing any residual amount from being left uninvested or uncounted.
Okay, so the fund has units, it has investments, and it has cash. How do we figure out the true worth of the entire collective pot? That's the calculation of net assets.
The net assets represent the true current net value of the fund. We calculate this by taking the current market value of the entire portfolio, all stocks, bonds, and cash, adding any receivables, like dividends that are due but not yet received, and then subtracting all fees, expenses, and liabilities related to running the scheme. It is the final, clean number.
And since the markets are volatile, these net assets are constantly fluctuating. Your sources gave us a great list of factors driving these changes.
Indeed. On the side of increase, net assets rise when investors buy additional units, increasing the total pool of capital.
Makes sense.
They also increase if the market value of the underlying securities appreciates, or if the portfolio earns passive income through dividends or interest from those underlying holdings.
And conversely, I assume, the pool shrinks when investors redeem units, taking capital out of the fund.
Correct. It also shrinks if the value of the underlying securities falls or when the scheme pays out its various operational and management expenses.
All of this fluctuation leads us to the crucial metric, the net asset value, or NAV.
Which is the net assets per unit. It is calculated simply by dividing the total net assets by the total number of outstanding units. And critically, all investor transactions, whether you are buying in or selling out, are conducted at this current NAV.
Okay, here is where it gets really interesting, and I think this often trips up new investors. We just established that buying or selling affects the total net assets of the fund. But does a large redemption or a massive new investment directly change the NAV per unit?
No, and this is a central piece of the fund's engineering designed for stability.
How does that work?
The NAV per unit is determined almost entirely by the portfolio's performance, the change in value of the underlying securities. When a transaction happens, say a big redemption, the fund pays out cash based on the current NAV.
Right.
So the fund's total cash decreases, but the number of outstanding units decreases in perfect proportion.
So the withdrawal of funds is perfectly offset by the corresponding cancellation of units, leaving the value per unit, the NAV, unchanged.
Exactly. It's like drawing water from a pool at one end.
Yeah.
The total volume changes, but the water level, the NAV, remains constant across the entire surface.
So the NAV remains a pure reflection of the underlying market performance, isolated from investor sentiment or transaction volume.
You've got it. It's an incredibly fair structure.
And to ensure that fairness is maintained across the complex daily movement of assets, two more operational mechanics are essential.
First, we have mark-to-market, or MTM. This is not optional. It's a regulatory requirement. The fund must value its entire portfolio on a daily basis using the most current market prices available.
Why is that daily requirement so strict?
Because it prevents abuse. If the NAV were calculated only weekly, an investor could say, look at Monday's massive market movement, see the NAV is likely to jump dramatically on Friday, and still try to buy units on Thursday based on Monday's stale lower price.
I see.
MTM ensures that the calculated net assets accurately reflect the real-time value, meaning no one can transact based on outdated information.
And the second point for operational fairness involves time. The strict adherence to cutoff timings.
These timings are non-negotiable because they determine the precise applicable NAV for your transaction. If you submit your purchase or redemption request before the 3 p.m. cutoff, for instance, you are locked in for that day's NAV calculation.
But if you miss it by even a minute,
You get the next day's NAV. This is crucial in volatile markets to ensure all investors operate on a level playing field and can't use late-day market information to gain an unfair advantage.
moving on, let's talk about Section 2, structure, regulation, and access points. The most fundamental structural difference dictates how easily you can transact and get your capital back.
That's the liquidity spectrum. We start with the most common and most liquid type, open-ended schemes.
The name says it all, really.
It does. You can continuously buy and redeem units directly with the fund house at the current NAV. The scheme is perpetual, designed to exist forever.
The opposite, then, is the closed-end scheme. They only offer units during the NFO period.
Right. Once that window closes, the fund stops selling new units, and it has a fixed, defined tenor, a lifespan of, say, 3 or 5 years. And the fund itself only redeems those units when that term is officially over.
This immediately creates a liquidity challenge, doesn't it? What if you need your money in year 2 of a 5-year closed-end fund?
The solution is regulatory. The fund is required to be listed. Investors can exit a closed-end fund before maturity only by selling their units to other investors on a stock exchange.
So you're not dealing with the fund house anymore.
Nope. You are selling your stake to a third party just like you would sell a stock.
And right in the middle, blending those two ideas, are the interval funds.
They are technically closed-end, but they have a unique feature. They become open-ended during specified periods. The sources specify a minimum of 2 days in that interval, allowing the investor a temporary window to transact directly with the fund house at NAV.
Offering guaranteed liquidity without relying on the secondary market.
Exactly.
That mandatory listing for closed-end funds provides a perfect bridge to discussing exchange-traded funds, or ETFs.
Yes, it does.
ETFs are essentially mutual funds that track an index or a specific commodity, but their defining structural feature is that they are listed and traded on a stock exchange throughout the day, exactly like a common stock.
And you buy them through a brokerage account.
Right.
The primary contrast with a traditional open-ended fund lies entirely in pricing. We know the open-ended fund has a single NAV calculated once at the end of the day.
But ETFs?
ETFs, however, operate in real time. They have multiple real-time prices throughout the trading day, fluctuating constantly based on demand and supply in the secondary market.
That real-time trading means an ETF price might temporarily trade at a slight premium or discount to its underlying NAV, unlike an open-ended fund which always transacts at its calculated NAV.
Precisely. Your sources highlight a popular segment here: gold and silver ETFs.
And this isn't a theoretical investment, is it?
Not at all. They have a strict mandate. Each unit represents a proportion of the weight of the physical metal held by the fund, which must be 99.5% purity gold or 99.9% purity silver. The fund houses are literally warehousing the metal.
So your return tracks the domestic prices of that metal, minus the fund's operational expenses.
That's it.
Shifting now from structure to oversight, we need to address the framework that makes the whole system trustworthy. The primary regulator governing everything we've discussed from the SID to daily MTM valuation is the Securities and Exchange Board of India, SEBI.
And working alongside SEBI is the industry body, the Association of Mutual Funds in India, AMFI. They provide oversight for the industry's general functioning, recommend best practices, and act as a representative body for the fund houses to liaise with the regulator.
And SEBI exerts control not just over how the funds operate, but over how they are designed.
Yes. They categorize all products into broad, clearly defined buckets: equity, debt, hybrid, solution-oriented, and other schemes. This categorization is fundamental for investor clarity and risk assessment.
And this leads to a critical constraint that has really reshaped the industry: the one scheme per category rule.
A huge change. What this means is that a single fund house can offer only one scheme per category, forcing them to focus their strategies clearly rather than launching dozens of marginally different products that confuse the market.
What was the regulatory intent behind that specific rule? Why did they do it?
Primarily, it solved the problem of product proliferation and label confusion.
Huh.
Historically, fund houses launched 5 schemes that sounded almost identical but had subtly different mandates.
I see.
This rule forces them to make one flagship large cap fund, one flagship mid cap fund, and so on.
But the sources also note there are exceptions.
Yes. Index funds, ETFs, and highly specialized sectoral or thematic funds are generally exempt. This makes sense because they are either passive vehicles or address such niche strategic opportunities that they don't violate the spirit of the one flagship product rule.
Before we move on, we have to touch on that fascinating niche detail you shared, the MF Light regulation.
Oh, right.
It's specific and new, rolled out on December 34th, 2024.
This is a great example of regulatory evolution. The MF-Light framework applies exclusively to mutual funds that run passive funds.
Okay, so just index funds and ETFs.
Exactly. Since passive funds don't require daily, complex stock-picking decisions, they just mirror an index, the regulator realized they could operate under a slightly less burdensome and costly regulatory framework compared to highly complex active funds.
So it's regulation being tailored to the complexity of the product.
You've got it.
Let's jump straight into Section 3, the equity playbook. This is where the strategies become specific, defined both by philosophy and by mandatory constraints.
We begin with the foundational choice, active versus passive. Passive funds are straightforward. They invest in exactly the same proportion as a specific index. There is no security selection, no expensive research team needed. They just mirror the benchmark.
And then you have active funds.
Right. These rely on the fund manager's talent and research. They use a detailed strategy intended to generate higher returns than the index that coveted alpha, through professional security selection, deep company research, and timely market entry and exit decisions.
The implication for the investor is cost.
Right. It is. Active management is resource intensive, which is why active funds usually command a significantly higher expense ratio than passive funds. You are, paying for the attempt to beat the market.
Okay, so the next layer of constraint comes from market capitalization, where SEBI mandates rigid allocation percentages to ensure the fund delivers exactly what the label promises.
These rules are mathematically precise. A fund labeled large cap, which focuses on the 100 biggest companies, must invest at least 80% of its total assets in those companies ranked first to 100th by market cap. This is the definition of a conservative equity allocation.
What does that 80% constraint do to the fund manager? I mean, does it limit their ability to generate alpha?
It absolutely limits their maneuverability. If 80% is locked into the top 100, the fund manager is mostly tracking the largest companies. Their active room to outperform the index comes only from that remaining 20%, and from the specific choice of which 80% they hold within that top 100.
So it's a fund designed for stability and minimizing downside, not necessarily for aggressive high returns.
That's a good way to put it.
The focus shifts for the next segment, mid-cap funds. That's companies 101st to 250th.
These mid-sized businesses offer higher growth potential but also higher volatility. They must invest a minimum of 65% of assets in that mid-cap segment.
And the same for small-cap funds.
Similarly, yes, small-cap funds, which is companies ranked 251st onwards, must also invest at least 65% of their total assets in that highly volatile segment.
And there's a mandated blend, the large and mid-cap fund.
Right. This category must balance exposure, investing a minimum of 35% in large cap and a minimum of 35% in mid-cap companies. This constraint ensures the fund cannot simply lean, say, 70% into the stable large cap segment when mid-caps are struggling.
It has to maintain a genuine balanced mix of stability and growth potential.
It does.
Now we get to the strategies that offer managers more freedom.
First, the multi-cap fund. This must invest at least 75% in equities, but it has a specific structural discipline. A minimum of 25% each must be deployed in large, mid, and small cap stocks.
Which guarantees diversification across size, which many investors seek.
Correct. Then you have the managerial favorite, the FlexiCap fund. This is the highest expression of freedom. The fund manager faces no minimum investment limits across the different market caps.
And that flexibility is a strategic advantage.
A huge one. In a rapidly shifting market where the manager might see small caps getting overheated and large caps becoming cheap, they can shift 100% of their assets in weeks.
So the FlexiCap structure allows for tactical allocation, whereas a multi-cap structure requires structural adherence to the 25% minimums, even if one segment looks terrible.
Precisely.
Beyond size, we look at specialization. the highly concentrated funds targeting specific segments.
Sector funds are the most concentrated. They must invest at least 80% of their assets in a specific sector, like technology or pharmaceuticals.
The reward is high if that sector booms, but the risk is significant due to the extreme lack of diversification.
Absolutely. Thematic funds are slightly broader, mitigating some of that single sector risk.
Yeah.
They still require a high commitment, at least 80% of assets, but they invest across multiple sectors that are unified by a common theme. For example, a green energy theme might include solar manufacturing, utility providers, and battery technology firms. 3 different sectors under one banner.
I see. We also define funds by their investment philosophies, which dictate how they choose the specific stocks.
Yes, the classic philosophical choice is the value fund.
And what's their approach?
Value funds hunt for the market's temporary errors. They identify companies they believe are trading below their inherent or intrinsic value based on metrics like earnings or book value. They are patient, expecting the market to eventually recognize the true price. It's a strategy that often performs well when high-flying growth stocks falter.
On the aggressive end, we have the Contra Fund.
These funds follow a contrarian strategy, specifically investing in underperforming or undervalued stocks, but only because they believe these stocks are depressed due to temporary market pessimism or transitory bad news, not fundamental problems. They are betting on a complete reversal of fortune.
And finally, a fund defined purely by constraint, the Focused Fund.
Right. These funds are limited by SEBI to a maximum of 30 stocks in the portfolio. This constraint forces the manager to make only high-conviction bets, which increases the non-diversification risk significantly, but also offers huge potential upside if those few bets pay off.
Before leaving equity, we must mention the tax and structural incentive,
Yeah.
the Equity-Linked Savings Scheme, or ELSS.
Ah, yes. ELSS is unique because it's the only mutual fund that provides tax deductions under Section 80C of the Income Tax Act.
But there's a catch.
There is. That tax benefit comes at the cost of a mandatory 3-year lock-in period. You must remain invested for those 3 years, making it an excellent vehicle for long-term tax planning.
Now we shift gears completely and move into Section 4, the Debt Playbook. In debt, the driving factors are not capitalization and strategy, but duration, credit quality, and interest rate management.
The core investment of debt funds is clear. They primarily invest in fixed income instruments like government bonds, corporate bonds, and short-term money market securities.
So their main objective is to earn predictable coupon income and preserve capital, rather than achieve the explosive capital gains sought by equity funds.
That's the idea. The categories here are defined by Macaulay duration, the sensitivity of the portfolio to interest rate changes, often measured by the time to maturity.
Let's start with the ultra-safe, short end of the duration spectrum, which often functions as cash alternatives.
We begin with absolute certainty, the overnight fund, which invests in securities with a maturity of exactly 1 day. Then there's the highly liquid fund, which holds securities with less than 91 days to maturity.
Ideal for parking emergency cash.
Very much so. The step up is the ultra-short duration fund, where the Macaulay duration is slightly longer, between 3 and 6 months. And the final fund in this safety cluster is money market fund, which invests only in instruments having a maximum maturity up to 1 year.
As we lengthen the duration, the interest rate risk begins to climb.
It does. A short duration fund has a duration between 1 year and 3 years. And at the high-risk end of the duration curve, we find long duration funds, where the Macaulay duration is mandated to be greater than 7 years.
And these funds will generate huge gains if interest rates drop.
But they will be devastated if rates rise sharply.
This brings us to the critical contrast in debt, credit risk versus default safety.
A corporate bond fund sticks to the highest quality credits. It must invest at least 80% of its assets in corporate debt rated AA+ and above. The default risk is low, and the returns are moderate.
Then you have the credit risk fund. This is where the manager takes a calculated risk on the issuer.
Exactly. They must invest at least 65% of assets in corporate debt rated AAA and below. The potential return is higher because you are accepting the higher primary risk, the chance that the issuer defaults on its debt obligations.
And at the absolute pinnacle of safety in terms of default, we have gilt funds.
Yes. They must invest at least 80% in government securities. Since they are backed by the government, the default risk is negligible. However, because these bonds often have very long maturities, they are hypersensitive to changes in overall interest rates.
So if rates are the biggest non-default risk, how do managers actively handle that volatility?
They utilize the dynamic bond fund. The manager of this fund doesn't adhere to a fixed duration mandate. They flexibly manage interest rate risk by actively shifting the portfolio's duration from short to long and back again, based entirely on their view of where central bank interest rates are headed.
Pure, active tactical management in the debt space.
That's it.
We also find highly structured debt products designed to eliminate interest rate risk by locking in the yield.
These are the fixed maturity plans, or FMPs. These are closed-end funds where the fund manager specifically selects debt securities whose maturities match the fixed tenor of the scheme.
Because the investor knows the bonds will be held until maturity, they are sheltered from the day-to-day interest rate fluctuations that affect liquid bonds. It offers high predictability.
Right. A more flexible take on that is the Target Maturity Fund, or TMF. These are open-ended funds that also have a defined maturity date, often tracking a specific bond index.
What's the key insight with TMFs?
The key concept is maturity roll-down. As the fund approaches its end date, the average residual maturity of its underlying bond holdings decreases every single day.
And as maturity shrinks.
The bond's price sensitivity to interest rate changes also shrinks. This process naturally reduces the fund's interest risk as the term approaches zero, giving the investor predictable, predefined risk reduction over time.
Let's look at the hybrid and other schemes that blend debt and equity, balancing stability and growth.
The spectrum starts with stability. The conservative hybrid fund places a massive 75% to 90% in debt, with only 10% to 25% in equity. This is income and preservation first, capital growth second.
Flip that ratio and you get the aggressive hybrid fund.
This is growth first, investing a mandated 65% to 80% in equity with the remainder in debt. The debt component is primarily a stabilizing anchor, designed to prevent the deepest losses during major market downturns.
Then there are specialized strategies that exploit market inefficiencies, such as arbitrage funds.
This is a complex but brilliant structure. Arbitrage funds aim for quasi-risk-free returns by exploiting small, temporary price differentials between the cash, or spot, and the derivatives markets.
How do they do that?
They simultaneously buy a stock in the cash market and sell its corresponding futures contract in the derivatives market, locking in the gap.
So since the manager holds the cash asset and the corresponding short position in the derivative, the overall market risk, if the stock price rises or falls, is almost entirely neutralized, leaving them with a small, predictable profit from the price gap.
Precisely.
We also have solution-oriented schemes which mandate commitment toward life goals.
Funds like retirement funds or children's funds have specific enforceable lock-in periods, often 5 years, or until the child reaches majority, to ensure the corpus is preserved to meet those long-term life goals.
Your sources also detail the structure of a fund of funds, or FOF. This is a mutual fund that takes investor capital and invests it only in other mutual funds.
Right, rather than holding direct stocks or bonds.
Why use a FOFF instead of just buying the underlying funds directly?
Often it's for access and diversification. What's important here is that FOFs can be used to invest in international funds, depending on their objective, granting you global diversification through a simple domestic purchase.
But they had a major tax status update in July 2024.
They did. Equity FOFs are now taxed at a rate of 12.5% plus surcharge and cess for an investment horizon over 2 years, which aligns their tax treatment with domestic debt funds, and that changed their utility somewhat.
Lastly, specialized debt structures include infrastructure debt schemes.
Yes, these are closed-end funds with a mandatory tenor of at least 5 years and are dedicated to investing in the debt securities of infrastructure companies to fund massive, long-term national projects.
That covers the landscape of products. Let's move to Section 5, which deals with the investor interface and transaction mechanics, the operational features you encounter when you own the fund.
The first choice is how you want your returns processed, growth versus IDCW.
The growth option is the simplest. All returns generated by the fund, dividends, interest, capital gains, are retained within the scheme. They are automatically reinvested, which leads to a constant increase in the NAV over time.
So you realize your profit only when you sell your units.
Exactly. The alternative is IDCW, income distribution cum capital withdrawal, which used to be called the dividend option.
Right. Here, the fund actively pays out returns in the form of distributions. When this cash leaves the pool, the NAV of the fund falls to the exact extent of the payout on that day.
And here is the absolutely crucial warning for IDCW investors that your sources emphasize. You must check the breakup of the amount received.
This is so important.
Unlike a dividend from a stock, which is usually pure profit, the IDCW payment can, and often does, include a portion of the investor's own original capital, which is why the NAV falls.
So it is not necessarily a pure profit distribution. It can be a return of capital.
To automate decision-making, some funds offer triggers.
This is a powerful operational tool. A redemption request is automatically activated when a preset condition is met. For instance, you could set a trigger to sell 50% of your holdings if the scheme reaches a 20% absolute return.
Ensuring you lock in profits without manually monitoring the market.
Exactly.
Now for the administrative bedrock. For a fresh purchase, the mandatory information required is extensive: name, date of birth, PAN details.
Critical for tax compliance.
Right. Bank account info, critical for transactions, address, and the signature of the primary holder.
Once you are an investor, you get a unique account identity, the folio number. This is the unique number under which all of your personal details and transaction history are permanently tracked.
And your sources note that a folio can accommodate up to 3 holders, which is great for family investments. All subsequent purchases are made simply by quoting that existing folio number.
Simple as that.
When it comes time to exit, the redemption amount is determined by the applicable NAV for the day, adjusted downward for any applicable exit loads.
Exit loads are essentially fees charged by the fund house for early withdrawals, typically designed to discourage investors from jumping out of schemes designed for the long term. If you redeem early, the amount is reduced by this load.
Here's a brilliant feature for the ultra-safe funds: the Instant Access Facility, or IAF.
This is a great one. Designed specifically for liquid funds, this allows resident individuals to receive redemption proceeds on the same day they submit the request, up to a limit of Rs. 50,000.
It gives these funds near bank account liquidity.
It really does. For non-resident Indian or NRI investors, the mechanism for redemption proceeds is complex and driven by compliance. The above accounts used depend entirely on the source of the initial investment.
Whether it came from repatriable NREF CNR or non-repatriable NRO funds.
Right, and this dictates whether the proceeds can be freely transferred overseas.
Finally, 2 in-house transactions. A switch involves a simultaneous redemption from one scheme and a purchase into another scheme within the same fund house.
It's a clean movement of capital, treated as a redemption followed immediately by a purchase for NAV calculation.
And if you choose the IDCW option, you can elect for dividend reinvestment.
In this case, the declared dividends are automatically used to buy more units of the same scheme at the post-dividend NAV, compounding your returns without requiring manual effort or cash withdrawal.
This brings us to Section 6, the core of disciplined investing. Systematic planning and advanced access. This is about making investment a habit, not an event.
The most famous tool for discipline is the Systematic Investment Plan, or SIP. A SIP is simply the investor's commitment to invest a fixed, predetermined sum at regular intervals, typically monthly, often through an auto debit.
The power of the SIP lies in the concept it facilitates: rupee cost averaging. This is the strategic insight here.
Rupee cost averaging is profound yet simple. Because you invest a fixed cash amount, the investor automatically buys more units when prices, the NAV, are low and fewer units when prices are high.
Over the long haul, this mechanical process smooths out market volatility and, critically, lowers the average cost of acquisition, reducing the risk of making a single, regrettable, lump sum investment at a market peak.
It's a fantastic discipline. The mirror image of the SIP is the Systematic Withdrawal Plan, or SWP.
And this is generally used in the wealth deaccumulation phase.
Correct. It provides a regular payout to the investor by automatically redeeming a specified number of units or a specified cash amount at a preset frequency, like a salary replacement in retirement.
Then we have mechanisms to move capital between schemes: the Systematic Transfer Plan, or STP.
This combines 2 transactions. It involves a periodic redemption from a source scheme, often a conservative liquid or debt fund, with a simultaneous programmed investment into a target scheme, usually an equity fund.
It's the mechanism you use to drip-feed a lump sum into volatile equities gradually.
Exactly. There's a variation on this called the Dividend Transfer Plan, DTP. When the source fund declares a dividend, that specific dividend amount is automatically transferred to a different target scheme instead of being paid out as cash or reinvested in the source fund.
A mechanism to channel passive income toward active growth products.
Right. And the most complex and arguably the most aggressive systematic method is the Value Averaging Investment Plan, or VAIP.
And it demands constant recalibration.
It does. Under VAIP, the goal is to maintain a targeted growth path for the entire portfolio value. To achieve this, the investor is forced to put in more money when the market is down than they would in a traditional SCP, and conversely, they put in less or even withdraw capital when the market is high.
It forces the ultimate contrarian discipline.
It really does.
Now, for the cost-conscious investor, we arrive at the most vital strategic choice, the direct versus regular plan. This is where you decide if you want to pay for advice.
The regular plan is the traditional default. In this plan, distribution commissions are paid to intermediaries, your agent, broker, or bank. These commissions are structurally built into the scheme's expense ratio, making the overall operational cost measurably higher for the investor.
The direct plan, then, is for the do-it-yourself investor.
Yes. Since they invest directly with the AMC, no commissions are paid. This results in a structurally and measurably lower expense ratio.
The portfolio paradox here is important to repeat. The underlying portfolio is absolutely identical for both plans.
Identical. The difference in returns over a decade or more is solely due to the lower cost of expenses in the direct plan, as that small percentage difference compounds dramatically.
However, the direct plan comes with a significant trade-off, the do-it-yourself approach.
Yes, the investor must handle all processes, monitoring and transactions tracking entry-exit loads, monitoring tax status, ensuring scheme objective adherence, without any intermediary support.
So the commission paid in the regular plan buys you that administrative workload management and professional guidance.
It does. An investment advisor's primary role here is to help the client decide if their time, expertise, and commitment are sufficient to manage the workload required by the direct plan, making the expense ratio saving worthwhile.
For advanced investors, accessing these funds via the stock exchange is becoming more common.
Yes, investing through the stock exchange platform offers significant benefits, notably seamless transactions similar to trading stocks, which simplifies execution.
Crucially, using the stock exchange platform eliminates certain counterparty risks through the use of clearinghouses, and it provides the investor with a single, consolidated view of their entire portfolio, including both stock holdings and mutual fund holdings in one place.
Finally, let's touch on the cutting edge of fund offerings. SEBI recently introduced a new asset class designed to sit structurally between traditional mutual funds and high-end portfolio management schemes, or PMS.
And this specialized fund requires a very high minimum threshold of 10 lakh from investors.
It does. And for wealthy individuals, the accredited investor designation offers special access. These individuals meeting high income or net worth criteria can invest with a lower ticket size of Rs 25 lakh in certain alternative investment funds and other specialized MF products, which normally have much higher entry barriers.
And we should acknowledge the regulatory mandate when a scheme shuts down.
Yes. If a scheme is being wound up, SEBI mandates that it must be listed on stock exchanges. This is a critical step to provide investors with the liquidity path during the realization period while the fund liquidates its underlying assets.
What a journey. We started with the potluck analogy, defining the structure. The sponsor sets it up, the trustee protects the investors, and the AMC manages the money. We then learned that the valuation is daily and fair, thanks to mark-to-market and the way NAV shields a portfolio from transaction volume.
We covered the vast strategic options. The liquidity choices between open and closed funds, the mandatory allocation rules for equity that enforce strategic discipline, and the tactical management of rate risk and debt through dynamic bonds, and the concept of maturity roll-down in target maturity funds.
And most critically for you, the learner, we made the distinction between paying commissions for convenience in a regular plan versus shouldering the administrative burden for the expense savings in a direct plan. Hopefully, you now possess the foundational knowledge to truly understand the engine of your investment vehicle.
If we connect this back to the bigger picture and the concept of predictable risk in debt funds, we establish that fixed maturity plans and target maturity funds are structured to eliminate interest rate risk by having the bond maturities match the scheme's end date.
Right, a high degree of certainty.
Exactly. It promises a high degree of certainty for the final payoff. However, we also noted that SEBI mandates that any scheme being wound up must be listed on an exchange.
I see where you're going with this.
This raises an important question. When a highly structured debt product designed for maturity certainty is suddenly forced onto a volatile stock exchange during a winding up, how does that listing requirement introduce a temporary unforeseen liquidity risk, and how should an investor think about the absolute guarantee of the maturity payoff in that specific regulatory scenario? It sort of shifts the risk calculus for these highly stable products.
Food for thought, indeed. That's all the time we have for this deep dive. Thank you for bringing us these sources, and thank you for tuning in.